Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically in the financial system what we are doing, we are covering the mutual funds. Okay, and in the topic of the mutual funds you can say that these are the subtopics we have scheduled for the discussion, like starting with the introduction part, then the basic history, okay, then the growth of the mutual fund industry, types of the mutual funds, regulation, investor participation, and the conclusion. All right. Out of these, how many topics we have covered? We have done with the introduction part, basic history, growth of mutual fund industries. The topic we had started for the discussion is the types of the mutual funds. All right. And then the topics we are left with is the regulation, investor participation, and the conclusion. So this is the picture you could say we have created so far altogether. All right. I hope that you have revised the previous lectures in the well enough manner before you have come for this lecture. As so many times I have told you, that is for your own benefit. If you are doing this, then the things will not be compiled up on you when you will give the examination. Okay. So let's start from where we had left in the previous lecture. So gilt funds, we had discussed in the previous lecture that these are the types of the debt instruments which does not providing any kind of ownership, but yes, you become the part of the shareholding. You are entitled to receive the fixed returns. Okay, and the one thing which we had discussed is that gilt funds are basically used for the government securities. Okay, it is also known as GSEC, means government security. All right. Thereafter, now we have the hybrid funds. Okay, hybrid funds, also known as the balanced funds, invest in the mix of equities and the debt instruments. Okay, why they are called the balanced funds? Because we had discussed about them in the previous lecture, that these are the balance of equity funds, okay, plus debt instruments, right? And these are balanced because these funds aim to provide a balanced portfolio with a moderate risk. Like, from one part you are entitled to receive the fixed returns, okay, and from one part you are entitled to receive high or low returns. Okay, in one part you having no risk, in one part you having the risk. All right. Hybrid funds are suitable for investors seeking a combination of capital appreciation and the regular income. Why? Because as we had discussed, suppose if you having, or you can say if you had invested rupees 60 crores. Okay, so the company which we were discussing about, like the XYZ, all right, the XYZ had a condition that out of the total amount which you had invested in the shares, 50% of the part will be the equity and the rest 50% will be the debt. Okay, so if we you could say break down this situation, all right, 30 crores equity, 30 crores debt. All right. So as we know, the equity portion always provides the ownership, whereas the debt portion always provides a fixed return. Okay, so here if we look at this particular, you can say the statement, like combination of capital appreciation and the regular income, like you could say, because now you having the ownership in the XYZ, So as the business of the XYZ will grow up, your stakes and your returns will always be growing up. Okay. So that's why this offers you the capital appreciation. Okay. However, there may be some capital depreciation. Why? Because as now you have become the owner, now you have the stakes in the XYZ. So anything happens with the XYZ will have the equal impact on yourself also. All right. But from the investor's point of view, no one wants to invest in the, you can see the shares and the stocks which are going to be declined. Okay. So we always take the positive side. So that's why capital appreciation is written here. All right. Whereas we know that fixed returns ensures the regular income. It means that doesn't matter whatever happens to the XYZ, you are entitled to receive the fixed return on your investment. Okay. So you are going to get the both. You are going to get the capital appreciation as well as the regular income. Okay. So that is the facilitation provided by the hybrid funds. Index funds. Now this is the topic we should discuss. Index fund replicate the performance of a specific stock market index, such as the Nifty 50 or Sensex. The investment portfolio of an index fund mirrors the composition of the chosen index. Index funds offer diversification across a broad market segment and typically have lower expenses compared to the actively managed fund. Now, come back. So basically, if we, you could say when we have read out this paragraph, okay. So here we have find something. The first thing we have find is the replicate. It means that copying. Okay. Thereafter, we have find two index here. Okay. So now I'm going to ask you the question. You are required to tell me that Nifty 50 belongs to which stock market and Sensex belongs to which stock market. All right. And how many companies are in them. All right. So you're having 20 seconds to think about it. Then I will tell you the answer. Your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. The time's up. So basically, if we talk about the Nifty 50, Nifty 50 belongs to the National Stock Exchange, NSE. All right. But if we talk about the Sensex, Sensex belongs to the Bombay Stock Exchange, BSE. All right. Nifty 50 having the 50 top performing companies. All right. Bombay Stock Exchange having 30 top performing companies. Okay. So that is the thing. Got it? So basically now we have, you could say, revise these things. Now the question is, what do you mean by the index fund? Okay. So basically you could say, first we should, you could say, see the formal definition. Then we will understand them. So by the formal definition, you could say that index funds contains, you could say, top companies from a stock market. So investor does not require to pick individual stock and put expertise and time on selection. Okay, so it is a formal definition, like it's contain the top companies from the stock market. So investor does not require to pick individual stocks and put expertise and time in selection. For example, suppose this is you. You are the investor. This is, for example, Nifty 50. Okay, so how many companies are there in the Nifty 50? Total 50 top performing companies are there. All right. So what is happening? Like you want to invest in the shares in the stocks, but you do not having that expertise. You do not having that time that you will examine these companies on the individual basis. Then you will decide that in which companies you have to put the stocks and all. All right. This kind of things. Okay. But here comes the index funds. Okay, suppose out of these 50 companies, there are some companies like ABC, XYZ, PQR, TUV, okay, you can say SFP, not P, okay, just convert it R. So this type of companies, for example. Okay, so out of these 50 companies, these companies are the top performing companies. All right. So what will happen? The index fund will generate the money, okay, so that it could invest the money into these top performing companies, and the returns which will be generated from these companies will be distributed amongst the funds member. Got it? That's how the index fund works. So basically, index fund is just doing the copy or the replication. All right, because these 50 companies are not from the index fund. These are from the Nifty 50, the stock market. But they are performing well. So you can say their growth also been reflecting in the Nifty 50, and the same growth is reflecting in the index fund. Okay, so the question is why it is helpful for the investor. Like suppose, let's understand it. When you were working on your own, what does it mean? It means that you have to examine the Nifty 50 companies. You have to go through the you can say profit and the losses of the companies on the individual basis. You require that much of expertise, that much of time, efforts, knowledge and all, right? That would be the thing. But by examining the index fund, you get to know that ABC, XYZ, PQR, TUV, SWR. These are the top performing companies. You do not have to do your individual research. Okay. By just the replication of the index, you get to know that these companies are top performing. So what will happen? That the index fund will be a bridge between you and the top performing companies. You will invest your money in the index fund. The index fund will invest the money into the performing companies. Okay, then the returns will come to the index fund, from index fund to you. All right. So that's how the index funds benefits the investor, because no longer the investor is required to do a research by himself. Okay. So remember, this fund replicate the performance of the specific stock market index such as the Nifty 50 or Sensex. Investment portfolio of the next fund mirrors the composition of the chosen index. Like whatsoever growth these companies have been showing in the index, the same growth will be shown in the index fund. Okay, so that you could get an accurate idea that what is going on with these companies. Thereafter, next is index fund offers diversification across a broad market segments and typically have lower expenses compared to the actively managed funds. Why broad market segment? Because all these companies will belong to the different areas. Okay, lower expenses, because when you go to the individual basis, you have to do research and all times, so that will be a costly for you. But when you go to the index fund have already, you can say, arranged those things which you require for you. then the things will be much more easier for you in comparison with the other things. All right. Thereafter, exchange traded funds. ETFs are similar to the index funds but are listed and traded on a stock exchange like the individual stocks. Investors can buy and sell ETF units throughout market hours at market determined price. ETFs offer flexibility and liquidity, making them suitable for short-term trading or the long-term investments. They also provide diversification and cost effectiveness compared to the direct investments in stocks. Okay, so basically if we talk about the ETFs now, okay, so what are ETFs? So you could say that ETFs are similar like stock market as deals in shares, bonds, debentures, and commodities. Okay, traded all day at market price of the fund. Okay, so remember, the exchange traded funds is like the similar like the stock market as deals in the shares, bonds, debenture, and the commodities traded all day at market price of the fund. Like you could say, suppose this is ETF. Okay, so ETF will having the investment into the shares, debentures, all right, bonds, okay, and commodities. Okay, so if you are the investor, okay, and you want to participate into the EPF, okay, then what will happen? Through ETF, you could go to the shares also, you could go to the debentures, bonds, and commodities. All right, even you could simultaneously bout them, right? That is the, you can say the thing you have got it. All right, the best thing is that is traded all day at the market price of fund. For example, suppose through ETF you had invested rupees 40,000 and bought some shares. Okay, bought some shares. Now here is the market price of fund, or you can say market price of security basically. All right, so market price is depend upon demand and supply. The simple rule will work here. Like if the shares which you have bought, their demand is high but their supply is less, what will happen? The prices will be goes high. But on the another term, if the demand is less, supply is high, what will happen? Prices will be falls down. Okay, so this condition goes all day long. Okay, it means that at some point of time in the day, the prices will be higher, another time may be lower, then higher, then lower, then higher, then lower. Okay, it means that throughout the day you having the chance to sell out your security, take your money back, whether at an increased rate or the decreased rate or at the same rate. Okay, like suppose when you had sell out the security holding through the ETF fund, then the prices will be higher. Then what will happen? You will be in the profit. But when you withdraw your money, the prices were at lower, then what will happen? You will be at loss. But if both the demand is equal to the supply, demand is equal to the supply, what will happen? The prices will remain as it is. Okay, so what will happen? Profit will be the same. All right. Or not profit, you could say investment. Like, suppose you have bought it in 40,000, you will receive 40,000. Okay. No more, no less. All right. So that's how the ETF work. But remember, when we talk about the ETF, then ETFs are very much similar to the index fund. Why? Because they are also showing the shares, debenture, bond commodities of the top performing companies. Top performing companies like the index fund does. But the one difference is there that traded all day at the market price of the securities, which means that all day long you could buy or sell your securities, your share through the ETF. But when it's come to the index fund, then remember, index funds always traded at the end of the day. All right. And value does not calculated on market price, but on NAV, which stands for net asset value. So remember this thing. Okay. Index funds are not traded all day long. They are always traded at the end of the day. And the value does not calculate on the market price. It means that does not depend upon the demand and supply like the ETF, but on the NAV, net asset value. What do we mean by net asset value? We will see in the upcoming slides. Okay. So I hope that you have understood the concept of the index funds and the ETF. All right. However, you could say that we will discuss them in the upcoming lectures in the more detail. All right. Even we will try to understand that what do we mean by the net asset value. It stands for NAV. Okay. So students, basically in this lecture, you could say that we have finished till here. In the next lecture, we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.